Everyone, this is George, a neighborhood realtor, and here with me is Eric Estevez, VP of Business Development and the Bayonne branch manager of First Alliance Home Mortgage. Eric, thanks so much for being here. I'm looking forward to everything that you have to share with us today.
Awesome. Thanks for having me, George. It's a pleasure being here with you today. You always add so much value, and I look forward to doing that alongside with you today.
Thank you. So, Eric, why don't you begin by just introducing yourself so everyone can get to know you a little better, who you are, what you do, and how long you've been in the industry for.
Yeah, awesome. Thanks, George. Yeah, my name is Eric, and I've been in the business for a little under 3 years now, right? But it feels like a much longer time, and I'm blessed that my father, I kind of grew up in the business. My father's been doing this for 27 plus years. So I kind of always had an understanding of it. But before I joined the mortgage industry, I've always led large teams, right? So, upon graduating college, I worked for Target stores and worked my way up and ran stores there. And then I actually transitioned to Walmart and ran stores there. So I always worked for really, Fortune 50 companies, led hundreds of people, retail, right? Customer service is always on top of mind. So processes, efficiencies. So that's always kind of been, for 14 years, that's how kind of I was built to just lead teams and look at processes. And I was fortunate that as I grew, right, in my position, in my stature, and I used bonuses to start investing in real estate, and I just started getting that itch, and I saw myself getting a little bit more excited about that, right? When I was going to work every day, and I just decided, I said, you know what, now or never. I've always wanted to be an entrepreneur. I tried some other things, right? I've developed apps before. I wrote a children's book with my wife, and I've always just had that entrepreneurial bug. And I said, you know what, why not try my hand at the industry that my father's been in for 27 plus years and just translate my experience, my leadership to the mortgage industry, just kind of give it a fresh breath air. And that's what we've been doing. A little over 2.5 years ago, George, it was me and my father in an office in Bayonne, just by ourselves, rocking and rolling. And I was coached from day one. I got coached by core training. I always had mentors, and we just started rocking out. And I trained before I hired. I built infrastructures. I looked at processes, and that's what we did, right? So in a short amount of time, we hired a team, right? We hired processing. We hired loan officer assistants. I have loan officers that reported to me, and grew pretty quickly, and growing. And one of the reasons I think is because we had the knowledge that my father had, and even though he's helped me flatten the curve, right, the learning curve, we have that plus my ability to build and develop teams and look at systems, and we've been able to grow pretty quickly. I attribute it to, I always attribute any success that we have to the team, right, that we have. They're amazing. We make sure that we hire good people but before anything, to make sure that they support the back end of things. So yeah, and now we're looking to continue growing and doing bigger, better things, and hiring more people. And I look forward to expanding. And I was recently promoted to VP of Business Development because we've been able to build a successful branch in such a short amount of time that we're at a level where we can actually teach other people how to do that too.
That's awesome. So you took your leadership skills and you applied it to the mortgage industry.
Yeah. Totally different industry, but I think leadership applies anywhere you go. Obviously I had to get into the nitty gritty and learn about loans and make mistakes. And I tell people this all the time. I think I've probably made more mistakes than any other loan officer in the last couple of years, right? But I say that with pride. A lot of people may not admit that. I say that with pride because I learned from those mistakes, and I'm not gonna make it again. And really, you grow through pain. So now we're at a point where I feel comfortable, and I do all kinds of loans. I've done a lot of different kinds of loans with you, George, right? Whether it's tax ID, ITIN loans, FHA 203Ks, conventional, and you dive in and you learn and you become an expert. And I've grown my business by really adding value, by educating people. And when you educate, you're educating yourself too, right? Because there's questions and you don't know, you got to go back. So I always make sure that I put myself out there and just try to give as much value and educate as much as possible.
That's awesome. So you mentioned you're the branch manager in Bayonne. Do you do you service only Bayonne, or what are your areas of expertise as far as what different cities, towns, counties do you service?
Yeah, I service all of New Jersey. I mean, in the end, numbers are numbers, right? And guidelines are guidelines. It just depends on where in New Jersey are you gonna find a house in that price point. But I service all of New Jersey. That's my bread and butter. I do New York and Pennsylvania as well. But 95% of my business is right here in all of New Jersey, and I do all counties. So even though my office is based in Bayonne, and we do a lot of deals in Hudson County, I live in Union County, so I have a lot of relationships out here. But I mean, I'm in Essex, Passaic, Bergen, Middlesex. So I'm really all over New Jersey.
And it's funny that you mentioned that. I had no idea that you were licensed in New York. You say you do business in New York and PA.
Correct. We do.
Okay,
I
that's
do.
awesome. So I can refer you clients that are looking in the area. I had no idea actually before this conversation.
Yeah, absolutely. I love to help.
Awesome. So Eric, there are a lot of first-time home buyers or families, clients in general, that are interested in purchasing their first home, but they're not aware of what they need, or they fully don't understand the entire process of, okay, how do I get started on buying my first house? And I want you to explain that process as far as documents, income, credit. What do you need really to get started if your goal is to buy your first home?
Yeah, I think talking to a professional like myself is the first step, because buying a house can seem very daunting, and a lot of people think that it's just too stressful, and they don't want to go through it. But it doesn't have to be, right? As long as you're working with someone, who you work with matters, right? And as long as you have somebody that explains things and just walks, and everybody has different levels of comfort, right? When they're buying their first house. But I think just having a conversation with somebody like myself to kind of just walk you through the process. And I talk to people all day, and in about 10 minutes I can I can find out about the situation. I can make them feel comfortable with the process. I can pre-qualify them over the phone just by asking them some questions, but I'll tell them what the steps would be in order to get pre-approved, and what kind of documents I need. So just to kind of dive into that a little bit, to pre-approve someone, you need I need to look at their income, their credit, and their assets, right? Those are the three things that I need to look at to determine if they can buy a house, right? And then how much of a house can they buy, right? By looking at those three things. And how do I assess that, right? Income you assess through income taxes and W-2s and pay stubs, right? You assess credit score by actually running credit. So we need a driver's license, right? Or social security number. We can run credit and just see not only what your credit score is, because there are minimum requirements in buying houses, especially in different programs, but also what are your liabilities, right? Because if you have a lot of monthly recurring liabilities, that you have to owe that, right? So now that may or may not bring your purchasing power down, right? Depending on liability. So we look at credit not only for score, we got to look at your liability so we can calculate your debt to income ratios. Do you have any collections in there, right, that need to get taken care of? Can we skip over some of those collections, and depending on what kind of collections and what programs, do you have bankruptcies, right? So that's how we check it. And a lot of times people don't know where the credit is at. So I tell them, hey, download Credit Karma. It's pretty simple. Credit Karma is not the end all be all, right? It does not necessarily mean that if you get a score from Credit Karma, that is going to be the score that I pull, because we're a commercial pull and our parameters are a little different. But it's a good start, right, to know where you're at, and I can kind of guide you a little bit better. So that's what we need. And then finally, the assets, right? We got to say, okay, well, how much money do you have available? How much money do you want to put down in the property? Because you may have $100,000 available, but you only want to spend this much money. So based on the assets, we can determine, okay, how much of a house can you buy? Because you might have great income, you might have great credit, but if you don't have any money, now it's going to limit you to what programs you can go into, right? And you might have to only go into a down payment assistance programs. And those are right now, I think we were talking about this offline, those are currently suspended, but they might come back, and that's something that you might have to jump into. So that's why we have to understand where you're at by looking at income, assets, and credit.
Got it. So let's say if you were to break it down, like if you were to make an outline, how many months worth of pay stubs or how many years worth of W-2 forms do you need? So we can um, shed more light on that and we can make it a kind of step-by-step process for someone interested in buying a house.
Got it. Yeah. So for the most part, most of the time when we do full doc loans, we're requiring 2 years history of tax returns and W-2s, right? So the last file 2 years, like right now, the extension to file taxes has been July 15th. So you can still buy a house with your 17 and 18 taxes, right? Then as far as pay stubs, we need your last month pay stub because that's going to give us the most accurate representation of what your pay is and what your year-to-date number is. Like, what are you full time? Are you part time? Right. So we need those pay stubs. So it's 2 years of tax returns, typically 2 months of pay stubs, right, and 2 months of bank statements, right, that we need to look at the assets. Right now, one thing that I do want to mention too, as far as assets. We can look at either assets that you have in a bank account. Do you have a 401k that you can take money out of? Do you have pension? Do you have a Roth IRA? Do you have a life insurance policy with a cash value in it? Or are you going to be gifted money, right? So as a first-time home buyer, you can actually be gifted the down payment. So that's something that we have to verify, and that's why in talking we know what we need and what we need to kind of show to say, hey, do you have this money available to purchase a property? Right. Now, keep in mind that when a bank is lending you money, they're assessing your risk level, right? So the more information we have, right, the better assessment we can make in order to, hey, are we going to lend you money and how much money can we lend you? There are times, George, that you only need 1 year's tax returns. There are times that you can do, W-2 transcripts loans. But that's going to be case by case. If somebody's income is really strong, if they're going to come down with a really strong down payment, right? So we look at all these parameters and we run it through what's called an automated underwriting system. And then they're going to say, okay, well, listen, in this file, this is what we need because there's a lot of other great compensating factors. So you only need 1 year tax returns, right? So I always ask for the 2 years and all that so we can have it. And if we only need to present 1 year tax returns, or if it's going to be better for the borrower to present 1 year tax returns, for example, if you've been self-employed for 5 years, right? You have a company for 5 years, and in 2017 you declare losses, but in 2018 you have a nice profit, right? Typically for self-employed borrowers, we have to use a 2-year average, right? We have to use a 2-year average. But if you've been employed for 5 years and you have great credit and depending on down payment, you may be able to only present your 1 month taxes, right? And now you have higher income to qualify. So that's why we have to look at everything on a case-by-case basis. But typically is 2, 2, and 2, right? 2 years tax returns, 2 months bank statements, 2 months of pay stubs.
Awesome. And you mentioned something, and I want you to elaborate on that a little bit. As far as gifting is concerned, can you explain that a little more? Like, what does gifting mean? What does that term mean for someone who maybe is not familiar with that word, with that process, or with that term?
Yeah. So here, that's just one of the cool things about the FHA program and just buying a house in general. I mean, the dream of homeownership is there within reach. And let's say you're buying a single family house of $300,000, and for an FHA product, you have to have a minimum investment of 3.5% to buy that property, right? Which turns out to be $10,500, but you'll have $5,000, right, in your account, but you're paying high rents, and it just doesn't make sense for you to pay the rent where you're at. So you have $5,000. So in essence, you're short $5,500 to be able to purchase that property, right? Now, if you have, right, if you have a family member, that, and there's certain guidelines on who can gift, there's certain guidelines of who can gift you the money, and they have to write a letter and say, hey, I'm going to give this money, and we still have to verify those funds, but they can give you the difference of $5,500 if you need it, right? It could actually be a little less, because I think we were talking about offline too, that couple thousand of those dollars, can be in a credit card if there's credit card availability, because you can pay some prepaid items like appraisal and inspection and homeowners insurance. But regardless, if you're short, you can get a gift, and that happens. Quite a bit. Where if you're short 1,000, 2,000 to make a loan work, we need this much. We need this much money. You can actually gift it. Now that means that they have to write a letter. Right? There's a letter that the company provides saying that I am George's father. I'm going to give them $5,500 for the purchase of his house. Here's my bank account information, right? Here's my 30 days bank statement, so it shows that the money's there. So that way we know, okay, we have the assets in his gift funds, right? So it can be gifted, which is a pretty cool thing, right? Which allows you to get into your house much quicker.
So I want you to explain also, Eric, what are the different programs that are available for, let's say, a first-time home buyer, or maybe like a seasoned investor? What are the different programs that someone has available for them? If you can kind of explain that, and we can talk about the general programs like FHA, conventional, FHA 2 or 3K loan. Can you explain those a little bit more in detail? What's the down payment requirement? What's the credit score requirement? Because I believe in general, there's a lot of misconception for a first-time home buyer of, I need this amount of money to put on my down payment for my first home, or I need a 700 or 750 credit score to buy my first house. And I don't want you to explain what that process looks like, or what those programs look like, and what are the requirements for those specific programs.
Yeah, you know what? And there's dozens of programs out there, and but I'm going to talk about the most most common ones, right? As a first-time home buyer, we talked about the FHA loan provided by the Federal Housing Authority, and this is a loan that's insured by the government, and because it's insured by the government, they can take a little bit more. The banks can take a little bit more risk. And how do they take more risk? You can put less of a down payment. We talked about putting 3.5% down, right, of the property of the house. A lot of people have this misconception that they got to put 20% down on the property. That's not necessarily true. You can put 3.5% down, right? Also, your credit score doesn't have to be as high, right? Because this program is also insured, right? Pre-COVID-19, right? Most banks were doing 580 minimum credit score. Yes, the rates maybe wouldn't be the ideal, and you may have to pay points or whatever, but it was doable. Right, and the sweet spot really was 620 credit score, right, for an FHA. And since COVID, a lot of banks have tightened, right, the regulations for a lot of different reasons that we may or may not get into. But in the end, right, it allows these people to people with lower credit scores with not enough money, and also the debt to income ratios can be a little higher, which means that, right, if I make $100,000 a year, right, I can technically buy a house and pay $4,600 a month, right, in that property, right? So that's 46% of your salary, right? So what happens is that, it goes higher because it is insured by the government. Now, because it's insured by the government, right, and they allow people to get into the houses a little bit sooner, right? Then you have to pay some premiums. You got to pay a mortgage insurance premium, a PMI, right? Because you're putting less than 3.5% down, and you're paying for that insurance in case you default in that loan. And then you also have to pay a one-time upfront mortgage insurance premium when you close on the property. So there's some premiums that you have to pay in an FHA loan, because you're buying it with less money down. You're buying it with a lower credit score. You can afford a higher home because of debt to income ratios. And generally speaking, I think COVID has kind of changed a little things around the last 60 days. But generally speaking, you're going to get the best rates at FHA because they're insured by the government, right? So that's going to be the program that allows more borrowers to opt into much faster, right? Now, even though we talked about some of those cons of some premiums, I still rather buy my own house with an FHA loan instead of paying rent, right? And we can go on and on about rent versus own, and I do seminars all the time, and we just put out graphs and just talk about it in numbers. But it's a really great program. So that's one of the most common ones. Now the same program also allows you to renovate a house, right? As long as you can be approved for the loan amount, right? So let's say if I can approve you for a $350,000 loan amount, and you see a property for 275, but you want to borrow $50,000, right, to renovate it, you're within what I approved you for, right? You're within that mortgage payment that's allowed that you can actually buy. So now you have these renovation loans. Now this is called an FHA 203K, right? Now you still need the 3.5% of the total loan amount with the purchase price of the house plus whatever you're going to borrow, right? You still need that amount, but those are very handy because listen, we live in New Jersey, and New Jersey, there's a lot of old houses, right? And if borrowers know that that's an option, you know, they might walk into a property, and if they didn't know that that option existed, they may not want the property. The property may be the perfect space, but maybe it's just outdated. Maybe they want a new kitchen. Maybe it's just, you know, that they didn't like it because it just didn't fit. It wasn't modern enough, right? The cool thing is that this 2 or 3K loan gives you the opportunity to look at a house and say, wow, you know, okay, I can fix this. I can fix that. I can buy this property. And the cool thing about it is it's what flippers do and investors do, right? They force appreciation, right? So they go in, they spend X amount of dollars on a property that they buy, right? And by investing X amount of dollars, when they sell it, they're gonna make X profit, right? Because you force appreciation, you add value, right? You're gonna do a new kitchen, new bathrooms, you're gonna do hardwood floors, paint, new basement. So what happens is that when you do that, when you get a renovation loan, the cool thing is that you most likely gonna have more equity in the property than if you were to buy it, right, in the seller's market like we have been, right? And I know that's a whole other topic, right? The shift and whatnot, but in the end, you know, you have more opportunity and you're creating value, right? So that's also some and a little bit more complicated, a little bit more steps. You have to get contractors involved and whatnot. But that's a great option that we're experts in, and we can help educate borrowers, right, so they can understand it. Because if you're going out there, George, and they give you your client knows that they're looking for a house in the 350 range, and one house checks off all of those check marks, that you do a nice thorough interview with what your client's needs are. But one of those check marks is a you know, nice modern kitchen, right? You can borrow that money to do that kitchen. So that's the cool thing about the FHA 203K. Great program. Okay. Again, COVID-19, some changes, some tightening of regulations. You know, but they'll come back when things settle, right? And they will settle. So that's. Go ahead. I'm sorry.
Yeah, no. Before you go with the 203K, in order for a client to use a 203K, does the property necessarily need to have, let's say, for example, $25,000 or $50,000 worth of renovations in order for the client to use that FHA 203K, or can it be just a simple, you know, upgrade, like, you know, touch-ups here and there? Maybe they want to change some doors. Like, does the house need to be really, really distressed in order for the client to use a 203K loan, or can they just do light renovations and still apply?
They can borrow $5,000 and, you know, 7, 8 do a roof, right? And it just depends. So again, as long as they can qualify for the mortgage payment with the extra loan on top, with the extra renovation money on top of it. Now these loans are a little bit riskier, so then you're gonna, you know, the interest rate isn't gonna be as favorable, right? So then, you know, obviously, you know, your payment may be a little higher depending, but I'll help you with that. We'll say, okay, well, is this good within your budget? And then typically what happens is once people get into 2 or 3Ks, they wind up refinancing down the road, bringing that rate back down, right? But you're already adding equity, and the bank is giving you money to add equity, which if you would have to spend on your own. If you didn't have it, you couldn't buy this house. So no, it doesn't have to be an astronomical amount. Now there's different kinds of 2 or 3Ks. You got streamlines, you got full 2 or 3Ks, and there's like a cutoff mark, right? Between a streamline, I think it's anything under $30,000 or so is going to be a streamline, and then full is over, which is extra steps, and you have to get consultants involved and whatnot. But it doesn't have to be an astronomical amount. As long as you can afford it, you can always do that as well.
Right. And you mentioned about refinancing because FHA 2 or 3K loans have higher interest rates. What's the maturity rate, or what's the seasoning period where you can buy the house and decide, you know, I want to refinance because I want to bring my mortgage payments down, I want to bring my interest down? What is the turnaround time to do that?
Yeah, so when you go into a 2 or 3K and you get a higher interest rate, you have to wait 6 months. You have to make 6 payments, you know, before you can refinance again, right? And typically you can either refinance and do what's called a streamline 2 or 3K where there's no closing costs, involved, but you get a better rate on that, or depending on the equity, depending on what you do, you might even be able to refinance into a conventional loan. But 6 months. So 6 months, you have to have your payment for 6 months, and I believe it's like 280 days, 230. I forget the exact amount of date, but it has to meet those two criteria in order for you to be able to refinance.
Got it. Okay. And you also mentioned about conventional. Now, can in your opinion, I know you said that if you're a first-time home buyer, you would want to take advantage of the FHA program, because that's the program where it requires you to put a minimal amount in down payment, 3.5%. Now, is there any situation in your opinion where you might recommend a first-time home buyer to not use a program, maybe use a conventional loan, and how, can you explain
Yeah,
what a conventional program
absolutely. Yeah. So conventionals are, listen, conventional loan, they're not insured by the government. So they have, you have to have better credit performance, right? Your debt to income ratio has to be a little lower. Your down payment may have to be a little higher, right? There's a couple programs that I can touch in a minute. But here's the thing: if somebody can afford the property that they're looking in, and they have great credit, and they have, depending on the money that they have, right, they can buy, a single family house with 5% down. If they have that, right, then they're going to avoid certain things that you would have to do in an FHA loan, like, pay that upfront mortgage insurance premium, right? That PMI that you have to pay in an FHA loan, you still have to pay that with anything less than 20% down in a conventional loan. But if you have good credit score, and depending on what you put down, right, it's going to be less than that of insurance PMI for an FHA loan. So what happens is that, the cool thing is that a conventional loan, if you get into it, if you put down 5% on a single family house, you got to just wait till the time to do the work, right? When you owe 80% of the value of the house, you can cancel that PMI, right? So with time, you're paying down principal and interest, and the value of the properties are continuing to appreciate. We did an analysis, George, that at the beginning of the year, Hudson County was forecasted to appreciate at a rate of 5.68%, right? Even post-COVID, that's been readjusted, but now it dropped to 4.68% appreciation. So it's still going to appreciate. So in the end, right, you're going to appreciate. It's going to appreciate, and when you have that 20%, you got to just basically, contact the bank, order an appraisal. They're going to verify the value of the property, and once you hit the 80% mark, you can cancel that. So you might be able to save a couple $100 on your mortgage once that happens. In an FHA loan, you won't be able to do that. Right? In an FHA loan, you put 3.5% down, and the only way for you to cancel it is wait till you get to that threshold, but you have to refinance into a conventional loan to cancel it, and there's an extra cost, right, to do that. So if I have a well-qualified borrower, and they have great credit, great income, they're buying a house that fits it, that hits that DTI ratio, they have the money, I'm gonna say, hey, it's a no-brainer. Let's go conventional, right? You're not going to have those extra things, those extra costs associated to it. So long term, a conventional loan is going to save you a lot of money, right? But in the end, it's a little bit more difficult to do a conventional loan, right? Now, one thing I will say is I talked about 5% for a single family house. There's a program. There are great programs. You have Home Ready, Home Possible, conventional programs for first-time home buyers, and there's thresholds, and it changes. Right, a couple years ago, there were no income limits in Hudson County in some areas where you could be making a lot of money and buy a single family house with 3% down, which is less than the FHA loan, right? But now there's a threshold. Right now, in most of the counties that I've been playing around with, we have to always check because there's a map. The income is about $64,000. Any more than $64,000, you can't do the 3%. You have to put 5% down for a conventional. Or here's a cool thing. And I'll circle back to the FHA program. In the Home Possible loan or Home Ready loan, you can actually put down 5% in a two-family house if you make less than that $64,000 and it fits that criteria, right? Which is pretty cool, right? In an FHA loan, you can put 3.5% down, right? No matter your income from a 1 family to a 4 family, right? So that's also one of the things, depending on what people are looking for, right? So I might have awesome credit, I might have awesome income, but I want to buy a 3-family house, right? And I don't have, I don't have 15-20% to put down conventionally, right? So then, you know what? Then let's do an FHA loan. You'll be able to get it. So there's a lot of different rules and regulations, and that's why it's good to just partner with a loan originator, because we not only look at numbers, we look at your story. What are your goals? What do you want to do? Do you want to buy multifamily, right? And then upgrade down the road. I talk to a lot of people about, that they want to buy single families, and I do seminars and webinars all across the state, George, for first-time home buyers. And we talk about the pros and cons of buying a multifamily house first, economically speaking, right? So we talk about all those things, but yeah, conventional, great programs, right? If people are qualified, if they've been saving for many years, they have good income, and they've just been preparing themselves, right? They're gonna walk into better terms, right? When it comes to not paying upfront mortgage insurance premium, paying lower PMI, they can buy up PMI, right? And right now, quite honestly, conventional rates have been better than FHA rates because of the pandemic, right? But we know things are going to settle, so they're kind of close to each other right now, an FHA rate and in a conventional rate.
What are the rates now, Eric? I'm curious. I know COVID-19 has impacted rates. In general, we are at a historic all-time low, but I'm curious to find out, what are the current rates right now for FHA conventional loans?
Yeah, so that's a great question, right? A lot of people call me, ask me about it all the time, right? I can always tell people, listen, you can just Google mortgage interest rates today, right? Mm-hmm. And let's see where they're at today, right? So and they rates change, right? Because they follow the bond and treasury markets, right? But now I'm looking at here, and they're saying, okay, mortgage rates today. You're saying for a 30-year FHA, you can get a 3.5%, right? For a 15-year fix, you might be able to get a 3.25%. Quite honestly, for somebody with a great credit score, right, 800 credit score, a 15-year loan, you might be actually closer to the higher 2s, lower 3s. So what happens is that when you look at rates, and I get this question all the time, hey, what interest rate can I get? The answer is I don't know, right? When you're looking at interest rates, you're looking at unicorn borrowers, you're looking at best case scenario. Everybody's different because right, we have to look at income, we have to look at credit, we have to look at how much money down, what kind of program are you doing, a primary residence, are you doing an investment purchase? So what happens is that rates, depending on what you want to do, really varies, right? So when you look at that, people say, yeah, rates are in the low 3s. Yeah, but if you want to buy a conventional, an investment property, you're not going to get a rate in the 3s, right? Because here's what it is: rates are there's a base rate, and then it's going to be depending on the borrower, right, and what risk level it is. If you're buying an investment property, you might have awesome income, awesome credit, but what happens? You're buying an investment property, you're not living in it. You're depending on your tenants to pay for that property. Now, we also have to consider vacancy factors, because there's going to be vacancies in there. What's happening right now, this is a perfect example with COVID. What's happening right now with investment properties? You have forbearance, right? Possibility forbearance. You have people in unemployment. So now, if I have an investment property, right, and my tenants are not working, right? How are they going to pay my rent? Now they're not paying my rent. How am I going to pay my mortgage, right? So now I have to go into forbearance, or I have to be behind those mortgages, because I want to make sure that I save my primary residence. So what happens is that because of the risk factor, and investment properties are more risky now than they were 60 days ago, right? But even in normal times, that's the case, right? You're depending on tenants to pay for your mortgage. So then the rates are going to be higher in an investment property, right? I had people say, oh, I heard rates are in the 3s. Hey, what's your credit score? 580. Well, guess what? You're not going to be in the 3s. You're not going to be in the low 3s, right?
I understand there's a lot of factors. It's on a case-by-case basis. It depends on the borrower.
It's so many different factors. It's risk level, right? And that's what a bank is underwriting a loan for. And this process, even though it doesn't have to be too stressful, right, it's very tedious, right? And that's why we look at bank statements and credit scores and your debt to income ratios, and all that is going to affect your interest rate, right? So yeah, and here's the thing. Right now, talking about where we're at with interest rates, and yeah, we're let's just say we're in the low 3s, mid 3s. for primary residences or refinances, let's say, we're still in historic lows, right? So what's great about it is, you know, the last 42 years, George, the average interest rate has been 8.42%. Okay, that's the last 42 years. Since 2008, we've been steady, right? We've been in the high twos, threes. Year and a half ago, right, we were creeping up in the fours, right? And now they've gone back. So we're still in historic low interest rate times. There's actually a lot of chatter, right, because of what's going on, because of the large amount of debt that the government is going to be in right now for all these stimulus package and to try to just continue to for the economy to continue pushing through. We're going to be in a lot of debt. So whenever there's a lot of debt, there's an inverse relationship to relationships, and that means that interest rates may continue to go down, right? Some people are speculating that we might see rates in the twos by the end of this year or next year, right? So what happens is that we're still in historic lows, right? So right now, a lot of the rates that we're locking are in that three range, but you know, somebody might get a 3.125 versus you getting a 3.875, right? And as long as we, the loan originators, educate our borrowers and say, hey, this is where you're at, because a lot of times people say, oh, I see that rates, you know, say that 3.125 today. And I go, yeah, but that's an 800 credit score. That's a, those are unicorn borrower. We gotta say, are you my unicorn borrower, right? And we get those all the time, but you know, I help a lot of families and communities, and they're not the unicorn borrowers. My job is to help them get there to buy a house, right? So sometimes we gotta work on credit, right? We gotta work on saving a little bit of money. We gotta get a little creative. So in the end, right now, buying a house, whether you're gonna be in the low threes, mid threes, high threes, right? Whether you wait next year, like, it's a time right for you now. Can you afford a house now, right? In the end, it's always better than renting.
Eric, there's so much information shared, and it's so valuable, and we definitely have to continue this. But I wanted to ask if someone is interested in reaching out to you, they're interested in buying a house, they're interested in being educated and figuring out what they need to do, what documents they need to bring, how can they start the home buying process? How can they connect with you directly to get started with that?
Yeah, right. I mean, I'm going to share this on Facebook, right? You guys can always just friend me on Facebook, shoot me a message. But just for you, those that are out there, you can always just contact me. My personal cell phone is the best way to reach me. I'm at 786-444-4160. But just go ahead and just click on my name, friend me, send me an inbox. We'll change information. We'll make an appointment, and I'll get the process rolling and see how it is that I can help you.
And I'll make sure to put your information below as well, so that anyone who is interested can reach out to you. Eric, thank you so much. Again, so much information. I think it's super important that we're here educating the public with home ownership, because it is important. And I believe that it is one way to financial freedom, is setting up your family to purchase property, and educating the client in doing so. I think that's extremely important. So Eric, again, thank you so much for all that you shared, and we definitely have to continue this, and I'm looking forward to our next conversation.
Awesome. Thank you, George.